Historically, the variable rate mortgage has proven to be more profitable than the fixed rate. In today's video, we're going to discuss the differences between variable and fixed rates and how the rising mortgage rates might affect your choice. But first, let's roll the intro. Hi everyone, Josh here, and before we start, I just want to remind you to hit that subscribe button and turn on the post notifications so that I can continue to make more content like this in the future. After more than a decade at a low level, mortgage rates are starting to rise again, and this brings back the age-old question: is it better to choose a fixed rate or a variable rate? According to a study published in 2001 by a finance professor at the University of Toronto, who analyzed more than 50 years of mortgage rates in Canada during that time, in 90% of the cases, the best interest rate choice was the variable rate. According to this study, the average savings on a $100,000 mortgage amortized over 15 years was $22,000. The world has certainly changed since 2001. However, does this study still stand true? Well, much of the decision between a fixed rate mortgage and a variable rate mortgage comes down to personal finance and depends on your personal situation. Before deciding which mortgage is best for you, you should ask yourself the following key questions. Do you have a stable job? Do you have disposable income in your monthly budget? How large is your mortgage? Consider someone with a large savings and a very stable job. This person would likely not have to worry so much about the interest rate fluctuating when it comes to a variable rate mortgage. However, on the other hand, someone with a more unstable job and who saved the minimum down payment of 5% with not much left over, they might be better off with a fixed rate mortgage. With this type of buyer, payments will be easier to budget and more secure. Not only do you have to ask yourself whether you can make the payments, you also have to consider where the real estate market and economy is headed. Since the beginning of 2022, the Bank of Canada has risen the key interest rate from 0.25% to 1%. As well, many experts expect it to continue to rise over the next months, with the next announcement coming in June. It's impossible to predict when the interest rate increases will stop, and therefore when deciding between a variable and fixed rate, you have to consider your ability to absorb fluctuating mortgage payments. The key benefit of choosing a variable rate mortgage is that it offers flexibility. If you plan on moving or upgrading properties in the near future, then a variable rate mortgage will usually have a much lower cancellation penalty. For a variable rate mortgage, the penalty will usually be equivalent to 3 months interest. However, for a fixed rate mortgage, the calculation is more complex and the penalties are usually quite a bit higher. Usually thousands of dollars higher actually. Variable rates can also be converted to a fixed rate at any time, usually without penalty. Whereas converting a fixed rate mortgage to a variable rate is not possible unless you cancel your mortgage and pay a fee. Another nice feature about some variable rate mortgage products is that even though the interest rate is variable, that doesn't necessarily mean that your monthly payments will fluctuate. Oftentimes, banks will provide variable rate mortgages that allow you to pay the same monthly amount each month. The only difference is that if rates go up, a larger portion of your payment will go to interest and a smaller portion will go to the principal. In this case, the term of your mortgage loan would also be extended since the principal is not getting paid down as fast. On the other hand, if rates go down, you'll pay less interest and more principal, despite having the same monthly payment, and the term of your loan will decrease. At the end of the day, the decision between a variable rate mortgage and a fixed rate mortgage depends on your current financial situation, personal situation, and where the real estate market is headed. If you're someone who wants a stable payment with an exact idea of how much of your payment is going towards the principal paydown, then a fixed rate is best for you. If you have a stable job, want a lower interest rate, and wouldn't be financially affected if the rates increase over time, then a variable rate mortgage would work better for you. Hopefully this video was able to point out some of the pros and cons of choosing a variable or fixed rate and can make your decision a little easier. If you're looking to get pre-approved in Montreal or in Quebec, then please reach out to me and I would be more than happy to refer you the best mortgage broker I know. If you've made it this far, I want you to let me know below in the comments which mortgage rate you think is best. Is it variable or fixed? Drop a comment below and let me know. That does it for this week's video. Don't forget to like, comment, subscribe, and turn on the bell notifications for more content like this. And I'll catch you next time.